$579 billion. That's how much capital rushed back into gold and silver in a single hour today, roughly the size of Visa's entire market cap, added back in 60 minutes. That is not something that happens in a market that's rolling over. It's a result of forced selling exhausting itself. What we just saw in silver wasn't a collapse driven by fundamentals. It was a paper event. Silver futures were smashed nearly 26% at the lows, one of the most violent moves in modern market history. But here's where things get interesting. The companies that actually pull silver out of the ground didn't follow. Silver miners barely budged relative to the metal. Some were down low single digits. Others were green within hours. The miners to silver ratio is now sitting near one of the lowest levels ever recorded. Why did that divergence actually take place? Mining equities are not day traders. They don't trade on margin hikes or intraday liquidation cascades. They trade on forward margins, cost structures, and what silver prices mean 6, 12, 18 months from now. If silver were genuinely breaking down, if demand was collapsing, if prices were headed materially lower, miners would be puking. They're leveraged businesses. Their revenues track the metal. Their costs don't move overnight. When silver falls for real, miners fall harder. That didn't happen. Instead, selling pressure showed up almost entirely in futures. Margins were raised, leverage was flushed, weak hands were forced out. Paper silver was dumped aggressively, while equity investors largely stood their ground. That tells you where the pressure came from. And the physical market confirms it. While COMEX silver printed around $80, Shanghai was paying roughly $111. India traded in the 90s. Japan retail touched 120. Kuwait over 100. A near 40% global spread. That's not normal volatility. That quote is price discovery breaking. In a functioning market, arbitrage closes gaps like that fast. Futures, ETFs, banks, refiners, that's their job. When a 40% spread persists across major hubs, it means the paper market is no longer setting a believable price. And miners see that. Many producers today are operating with sub-$15 all-in costs. Even at far lower silver prices than today, margins are enormous. At $25 to $30 silver, some top-tier miners generate 50 to 100% gross margins. That's software-like profitability in a commodity business. So when silver drops violently on paper, but miners barely react, the message is simple. Equity investors don't believe the move reflects reality. This isn't the first time we've seen it. In past cycles, sharp silver pullbacks flushed leverage without changing fundamentals. Miners often diverged first. The metal followed later. This time is no different, except the scale. What made this move feel extreme wasn't just the speed, it was the coordination. Margin hikes stacked on top of thin liquidity. Paper ounces flooded the market while physical silver stayed tight. Even China suspended silver ETF trading for a full day. That's containment. And yet even with all that, the bounce came fast. Gold up 3%, silver up 5%. Hundreds of billions back into metals almost instantly. That's what a proper retest looks like. Not a slow grind lower, not miners collapsing, not physical premiums disappearing, just leverage getting flushed. There's a debate floating around that miners will eventually flood the market with supply, digging silver at $15 an ounce in overwhelming demand. And maybe, months from now, supply responds. Every commodity cycle ends that way. But that argument has nothing to do with today. Markets don't discount supply that hasn't been mined yet. They discount expectations. And right now, miners are signaling that this paper smash didn't change the long-term picture. If silver were truly headed lower, miners would already be telling you they aren't. What we witnessed wasn't the end of the metals trade. It was the system trying and failing to reassert control through paper. And the miners didn't buy it. Game on.